Let's also bring on board James Thom, Investment Manager at Aberdeen Asset Management Asia. He joins us from Singapore. James, hi. If you can hear me, we were talking about how your clients are now receiving Modi coming to the hem when it comes to India.
Yes, I'm not sure at what point we got cut off, but yes, I think our clients are as positive as anyone about the political changes and potential in India. So a lot of enthusiasm, a lot of positive sentiment, tempered with questions over what is to follow and how it'll all shape out.
Right. James was someone who's got about $10 billion plus invested in Indian equities. Do you think your basic investment portfolio will change? Because for the longest time, you've run a portfolio which is a high quality portfolio, which is private banks, large cap IT and large cap pharma. Now that Indian economy is on the verge of making a comeback, is it time to shift your portfolio strategy?
That is our investment style and approach. We really focus on identifying the best quality stocks in India and try not to pay too much for them in simple terms. So we're very much bottom-up stock pickers with a sort of value bias, if you like. And therefore, whilst we share the excitement and sentiment around the political events, we're not repositioning the portfolio around the politics and around the changing macro environment, as positive as it may be. That's just not the way we invest. So we won't be changing materially the position of the portfolio in response to this.
James, my understanding is that of late you've bought into cement. Now that's a big portfolio shift. I know you've had decent exposure to cement in the past, but incrementally you've really bought aggressively into cement. So what's the call here? Are you buying into cement stocks because that's a proxy to Indian economy?
We've actually had a sizable position in cement for a long time, several years. You're right, we have increased that position somewhat. We did that through last year rather than this year, and we do see it as a proxy for hopefully greater infrastructure spending, also for the property sector where we have no exposure. And we felt last year that valuations were at fairly attractive levels. Utilization levels obviously very low with the economic growth slowing. So it was an opportune time, we felt, just to add a little to that sector. Those cement stocks have done very well. I think they have been seen as a proxy for future economic growth, and the election excitement has caused them to rally. So they're no longer as cheap as they were, but we still like the companies. We still feel the long-term prospects are very positive, and so we're happy to hold a sizable position there still.
James, are there any sectors or spaces where you're taking chips off the table and getting some profits booked?
Well, if you look at the stocks and sectors that have done well this year, there has been a big swing away from the sort of more defensive consumer names. For example, the IT services companies did very well last year. What's done well this year has been much more the capital-intensive, industrial-type stocks, and cement included in that, as well as financials. So really, the opportunity to take profit has come from those sectors that have just rallied very strongly in the run-up and post-election.